Tantor Audio, a division of Recorded Books, presents Real Estate Investing All-in-One for Dummies by Eric Tyson, MBA, Robert S. Griswold, MSBA, Lawrence C. Harmon, Ray Brown, Ralph R. Roberts, with Joe Cranak, James Svetek, Nicholas Walwork, Peter Conti, Peter Harris. Narrated by Charles Constant. Publisher's Note: in this audio edition, you will hear references to figures and tables present in the print and ebook formats of the book. Limit of liability/disclaimer of warranty. While the publisher and authors have used their best efforts in preparing this work, they make no representations or warranties with respect to the accuracy or completeness of the contents of this work, and specifically disclaim all warranties, including, without limitation, any implied warranties of merchantability or fitness for a particular purpose. No warranty may be created or extended by sales representatives, written sales materials, or promotional statement for this work. The fact that an organization, website, or product is referred to in this work as a citation and/or potential source of further information does not mean that the publisher and authors endorse the information or services the organization, website, or product may provide or recommendations it may make. This work is sold with the understanding that the publisher is not engaged in rendering professional services. The advice and strategies contained herein may not be suitable for your situation. You should consult with a specialist where appropriate. Further, readers should be aware that websites listed in this work may have changed or disappeared between when this work was written and when it is read. Neither the publisher nor authors shall be liable for any loss of profit or any other commercial damages, including but not limited to special, incidental, consequential, or other damages. Introduction. Successful real estate investing requires smart decisions. Real Estate Investing All-in-One for Dummies presents basic real estate investing topics such as buying and selling houses, investing in foreclosures, and flipping properties, but also introduces advanced subjects like international and commercial real estate investing that can help you build even more wealth. You even get the ins and outs of short-term rentals like Airbnb, so all your passive income options are covered. This book can help you start investing in real estate quickly and easily, thanks to expert tips and information that will help you avoid costly mistakes. It's your one-stop resource for all things real estate. Explore this book and find the topics that most interest you within the world of real estate investing. About this book. You don't need a fancy degree to invest in real estate. What you do need is a desire to read, absorb, and practice the simple yet effective strategies in this book. Real Estate Investing All-in-One for Dummies is designed to give you a realistic approach to investing in real estate. It provides sound, practical lessons and insights. You're not expected to read it from cover to cover. Instead, this book is designed as a reference tool. Feel free to read the chapters in whatever order you choose. You can skip to sections and chapters that interest you or those that include topics that you need to know more about. A quick note: sidebars, shaded boxes of text, dig into the details of a given topic, but they aren't crucial to understanding it. Feel free to read them or skip them. You can pass over the text accompanied by the technical stuff icon, too. The text marked with this icon gives some interesting but non-essential information about the subject of real estate investing. One last thing. Within this book, you may note that some web addresses break across two lines of text. If you're reading this book in print and want to visit one of these web pages, simply key in the web address exactly as it's noted in the text, pretending as though the line break doesn't exist. If you're reading this as an ebook, you've got it easy. Just click the web address to be taken directly to the web page. Foolish assumptions. No matter your skill or experience level with real estate investing, you can get something out of this book. Here are some assumptions we made about you as we wrote this book. You're new to investing in real estate and don't know what properties and strategies will work for you. Your real estate experience is limited to renting an apartment or owning your own home, and you're interested in finding out more about foreclosures, flipping, and other investment options. You may already be a seasoned real estate investor, but you're ready to go to the next level with commercial and international properties. You want to diversify your investment portfolio. Icons used in this book. Throughout this book, these verbalized icons help guide you through suggestions, solutions, and cautions. Here's what they mean. Remember. The name says it all. This icon indicates something really important to take away from this book. Technical stuff. Information marked with this icon is interesting but not crucial to understanding real estate investing. Tip. This icon highlights helpful strategies that can enable you to build your real estate portfolio and your wealth faster. Warning. This icon indicates treacherous territory in real estate investing. Skip this information at your own peril. Beyond the book. In addition to the material in the print or ebook you're reading right now, this product comes with a free Access Anywhere cheat sheet that can put you on the road to successful real estate investing. To get this cheat sheet, simply go to dummies.com and search for Real Estate Investing All-in-One for Dummies cheat sheet in the search box. Where to go from here? If you're a new real estate investor, you may want to consider starting from the beginning. Head to Book 1 on Getting Started. That way you'll be ready for some of the more advanced topics introduced later. But you don't have to read this book from cover to cover. Real Estate Investing All-in-One for Dummies makes it easy to find answers to specific questions. Just turn to the table of contents or index to locate the information you need. You can get in and get out just like that. Good luck. Book 1. Getting Started with Real Estate Investing. Chapter 1. Evaluating Real Estate as an Investment. In this chapter, focusing on the potential and downsides of real estate investing, contrasting real estate with other investing options, deciding whether real estate is really for you, arranging your overall investment and financial plans to include real estate. It's never too early or too late to formulate your own plan for a comprehensive wealth-building strategy. For many, such a strategy can help with the goals of funding future education for children and ensuring a comfortable retirement. The challenge involved with real estate is that it takes some real planning to get started. Contacting an investment company and purchasing some shares of your favorite mutual fund or stock is a lot easier than acquiring your first rental property. Buying property need not be too difficult, though. With a financial and real estate investment plan, a lot of patience, and the willingness to do some hard work, you can be on your way to building your own real estate empire. This chapter gives you information that can help you decide whether you have what it takes to make money and be comfortable with investing in real estate. You compare real estate investments to other investments. You find some questions you should ask yourself before making any decisions. And finally, you get guidance on how real estate investments can fit into your overall personal financial plans. Along the way, you find insights and thoughts on a long-term strategy for building wealth through real estate that virtually everyone can understand and actually achieve. Understanding real estate's income and wealth-producing potential. Compared with most other investments, real estate can excel at producing periodic or monthly cash flow for property owners. So in addition to the longer-term appreciation potential, you can also earn investment income year in and year out. Real estate is a true growth and income investment. Remember, the vast majority of people who don't make money in real estate make easily avoidable mistakes, which this book helps you avoid. The following list highlights the major benefits of investing in real estate. Tax-deferred compounding of value. In real estate investing, the appreciation of your properties compounds tax-deferred during your years of ownership. You don't pay tax on this profit until you sell your property, and even then you can roll over your gain into another investment property and avoid paying taxes. See the later section, Being Aware of the Tax Advantages. Regular cash flow. If you have a property that you rent out, you have money coming in every month in the form of rents. Some properties, particularly large multi-unit complexes, may have some additional cash flow sources, such as from parking, storage, or washers and dryers. Remember, when you own investment real estate, you should also expect to incur expenses that include your mortgage payment, property taxes, insurance, and maintenance. The interaction of the revenues coming in and the expenses going out tells you whether you realize a positive operating profit each month. Reduced income tax bills. For income tax purposes, you also get to claim an expense that isn't really an out-of-pocket cost: depreciation. Depreciation enables you to reduce your current income tax bill and hence increase your cash flow from a property. Find out about this tax advantage and others in the later section, Being Aware of the Tax Advantages. Rate of increase of rental income versus overall expenses. Over time, your operating profit, which is subject to ordinary income tax, should rise as you increase your rental prices faster than the rate of increase for your property's overall expenses. The following simple example shows why even modest rental increases are magnified into larger operating profits and healthy returns on investment over time. Suppose you're in the market to purchase a single-family home that you want to rent out, and that such properties are selling for about $200,000 in the area you've deemed to be a good investment. Note, housing prices vary widely across different areas, but the following example should give you a relative sense of how a rental property's expenses and revenues change over time. You expect to make a 20% down payment and take out a 30-year fixed-rate mortgage at 6% for the remainder of the purchase price, $160,000. Here are the details. Monthly mortgage payment, $960. Monthly property tax, $200. Other monthly expenses, maintenance, insurance, $200. Monthly rent, $1,400. Table 1.1 in the print and e-book versions of this book shows you what happens with your investment over time. Assume that your rent and expenses, except for your mortgage payment, which is fixed, increase 3% annually and that your property appreciates a conservative 4% per year. For simplification purposes, depreciation is ignored in this example. If the benefit of depreciation had been included, it would further enhance the calculated investment returns. Now, notice what happens over time. When you first buy the property, the monthly rent and the monthly expenses are about equal. By year 5, the monthly income exceeds the expenses by about $200 per month. Consider why this happens. Your largest monthly expense, the mortgage payment, doesn't increase. So even though you can assume that the rent increases just 3% per year, which is the same rate of increase assumed for your non-mortgage expenses, the compounding of rental inflation begins to produce larger and larger cash flows to you, the property owner. Cash flow of $200 per month may not sound like much, but consider that this $2,400 annual income is from an original $40,000 investment. Thus, by year 5, your rental property is producing a 6% return on your down payment investment. And remember, if you factor in the tax deduction for depreciation, your cash flow and return are even higher. In addition to the monthly cash flow from the amount that the rent exceeds the property's expenses, also look at the last two columns in Table 1.1 to see what has happened by year 5 to your equity, the difference between market value and mortgage balance owed, in the property. With just a 4% annual increase in market value, your $40,000 in equity, the down payment, has more than doubled to $94,370. $243,330 minus $148,960. By years 10 and 20, you can see the further increases in your monthly cash flow and significant expansion in your property's equity. By year 30, the property is producing more than $1,400 per month cash flow, and you're now the proud owner of a mortgage-free property worth more than triple what you paid for it. After you get the mortgage paid off in year 30, take a look at what happens in year 31 and beyond to your monthly expenses. Big drop as your monthly mortgage payment disappears, and therefore your cash flow, big increase. Recognizing the caveats of real estate investing. Warning: despite all its potential, real estate investing isn't lucrative at all times and for all people. Here's a quick outline of the biggest caveats that accompany investing in real estate. Few home runs. Your likely returns from real estate won't approach the biggest home runs that the most accomplished entrepreneurs achieve in the business world. That said, by doing your homework, improving properties, and practicing good management, and sometimes enjoying a bit of luck, you can do extremely well. Upfront operating profit challenges. Unless you make a large down payment, your monthly operating profit may be small, non-existent, or negative in the early years of rental property ownership. During soft periods in the local economy, rents may rise more slowly than your expenses, or they may even fall. That's why you must ensure that you can weather financially tough times. In the worst cases, rental property owners lose both their investment property and their homes. See the later section, Fitting Real Estate into Your Plans. Ups and downs. You're not going to earn an 8 to 10% return every year. Although you have the potential for significant profits, owning real estate isn't like owning a printing press at the U.S. Treasury. Like stocks and other types of ownership investments, real estate goes through down periods as well as up periods. Most people who make money investing in real estate do so because they invest and hold property over many years. Relatively high transaction costs. If you buy a property and then want out a year or two later, you may find that even though it has appreciated in value, much, if not all, of your profit has been wiped away by the high transaction costs. Typically, the costs of buying and selling, which include real estate agent commissions, loan fees, title insurance, and other closing costs, amount to about 8 to 12% of the purchase price of a property. So although you may be elated if in the short term your property appreciates 10% in value, you must consider the overall financial picture. You may not be so thrilled when you realize that selling the property may not have any greater return than stashing your money in a lowly bank account. Tax implications. Last but not least, when you make a positive net return or profit on your real estate investment, the federal and state governments are waiting with open hands for their shares. Throughout this book, you discover ways to improve your after-tax returns. Keep in mind that the profit you have left after government entities take their bites, not your pre-tax income, is what really matters. These drawbacks shouldn't keep you from exploring real estate investing as an option. Rather, they simply reinforce the need to really know what you're getting into with this type of investing and whether it's a good match for you. The rest of this chapter takes you deeper into an assessment of real estate as an investment, as well as introspection about your goals, interests, and abilities. Comparing real estate to other investments. Surely you've considered or heard about many different investments over the years. To help you grasp and understand the unique characteristics of real estate, the following sections compare and contrast real estate's attributes with those of other wealth-building investments like stocks and small business. Returns. Clearly, a major reason that many people invest in real estate is for the healthy total returns, which include ongoing cash flow and the appreciation of the property. Real estate often generates robust long-term returns because, like stocks and small business, it's an ownership investment. This means that real estate is an asset that has the ability to produce periodic income and gains or profits upon refinancing or sale. Research and experience suggest that total real estate investment returns are comparable to those from stocks, about 8 to 9% on average annually. Over recent decades, the average annual return on real estate investment trusts, REITs, publicly traded companies that invest in income-producing real estate, such as apartment buildings, office complexes, and shopping centers, has appreciated at about this pace as well. And you can earn long-term returns that average much better than 10% per year if you select excellent properties in the best areas, hold them for several years, and manage them well. Risk. Real estate doesn't always rise in value. Witness the decline occurring in most parts of the U.S. during the late 2000s and early 2010s. That said, market values for real estate generally don't suffer from as much volatility as stock prices do. You may recall how the excitement surrounding the rapid sustained increase of technology and internet stock prices in the late 1990s turned into the dismay and agony of those same sectors' stock prices crashing in the early 2000s. Many stocks in this industry, including those of leaders in their niches, saw their stock prices plummet by 80%, 90% or more. Generally, you don't see those kinds of dramatic roller coaster shifts in values over the short run with the residential income property real estate market. However, keep in mind, especially if you tend to be concerned about shorter-term risks, that real estate can suffer from declines of 10%, 20%, or more. If you make a down payment of, say, 20% and want to sell your property after a 10 to 15% price decline, you may find that all, that is, in 100%, of your invested dollars, down payment, are wiped out after you factor in transaction costs, so you can lose everything. Remember, you can greatly reduce and minimize your risk investing in real estate through buying and holding property for many years, 7 to 10 or more. Note that many of these fantastic success stories about amazing profits on flipping single-family homes and small rental properties are just like gamblers who only tell you about their biggest winnings and forget to tell you that they turned around and lost much of what they won. While there is a lot of hype on cable television and the internet about flipping properties for short-term profits, get the scoop in Book 4, think of real estate as a long-term investment. Liquidity. Liquidity, the ease and cost with which you can sell and get your money out of an investment, is one of real estate's shortcomings. Real estate is relatively illiquid. You can't sell a piece of property with the same speed with which you can whip out your ATM card and withdraw money from your bank account, or sell a stock or an exchange-traded fund with a click of your computer's mouse or by tapping on your cell phone. Remember, you can actually view real estate's relative illiquidity as a strength, certainly compared with stocks that people often trade in and out of because doing so is so easy and seemingly cheap. As a result, some stock market investors tend to lose sight of the long term and miss out on the bigger gains that accrue to patient buy-and-stick-with-it investors. Because you can't track the value of investment real estate daily on your computer, and because real estate takes considerable time, energy, and money to sell, you're far more likely to buy and hold on to your property for the longer term. Although real estate investments are generally less liquid than stocks, they're generally more liquid than investments made in your own or someone else's small business. People need a place to live and businesses need a place to operate, so there's always demand for real estate, although the supply of such available properties can greatly exceed the demand in some areas during certain time periods. Capital requirements. Although you can easily get started with traditional investments such as stocks and mutual funds with a few $100 or $1,000, the vast majority of quality real estate investments require far greater investments, usually on the order of tens of thousands of dollars. Tip: if you're one of the many people who don't have that kind of money, don't despair. Among the simplest low-cost real estate investment options are real estate investment trusts, REITs. You can buy these as exchange-traded stocks or invest in a portfolio of REITs through a REIT mutual fund. Diversification value. An advantage of holding investment real estate is that its value doesn't necessarily move in tandem with other investments, such as stocks or small business investments that you hold. You may recall, for example, the massive stock market decline in the early 2000s. In most communities around the United States, real estate values were either steady or actually rising during this horrendous period for stock prices. However, real estate prices and stock prices, for example, can move down together in value. Witness the severe recession and stock market drop that took hold in 2008. Sluggish business conditions and lower corporate profits can depress stock and real estate prices. Opportunities to add value. Although you may not know much about investing in the stock market, you may have some good ideas about how to improve a property and make it more valuable. You can fix up a property or develop it further and raise the rental income accordingly. Perhaps through legwork, persistence, and good negotiating skills, you can purchase a property below its fair market value. Relative to investing in the stock market, tenacious and savvy real estate investors can more easily buy property in the private real estate market at below fair market value because the real estate market is somewhat less efficient and some owners don't realize the value of their income property, or they need to sell quickly. Theoretically, you can do the same in the stock market, but the scores of professional, full-time money managers who analyze the public market for stocks make finding bargains more difficult. Being aware of the tax advantages. Real estate investment offers numerous tax advantages. The following sections compare and contrast investment property tax issues with those of other investments. Deductible expenses, including depreciation. Owning a property has much in common with owning your own small business. Every year you account for your income and expenses on a tax return. Be sure to keep good records of your expenses in purchasing and operating rental real estate. One expense that you get to deduct for rental real estate on your tax return, depreciation, doesn't actually involve spending or outlaying money. Depreciation is an allowable tax deduction for buildings because structures wear out over time. Under current tax laws, residential real estate is depreciated over 27.5 years. Commercial buildings are less favored in the tax code and can be depreciated over 39 years. Residential real estate is depreciated over shorter time periods because it has traditionally been a favored investment in U.S. tax laws. Tax-free rollovers of rental property profits. When you sell a stock, mutual fund, or exchange-traded investment that you hold outside a retirement account, you must pay tax on your profits. By contrast, you can avoid paying tax on your profit when you sell a rental property if you roll over your gain into another like-kind investment real estate property. Remember, the rules for properly making one of these 1031 exchanges are complex and involve third parties. Make sure that you find an attorney and/or tax advisor who is an expert at these transactions to ensure that you meet the technical and strict timing requirements so everything goes smoothly and legally. If you don't roll over your gain, you may owe significant taxes because of how the IRS defines your gain. For example, if you buy a property for $200,000 and sell it for $550,000, you not only owe tax on the gain from the increased property value, but you also owe tax on an additional amount, the property's depreciation you used during your ownership. The amount of depreciation that you deduct on your tax returns reduces the original $200,000 purchase price, making the taxable difference that much larger. For example, if you deducted $125,000 for depreciation over the years that you owned the property, you owe tax on the difference between the sale price of $550,000 and $75,000, $200,000 purchase price minus $125,000 depreciation. Deferred taxes with installment sales. Installment sales are a complex method that can be used to defer your tax bill when you sell an investment property at a profit and you don't buy another rental property. With such a sale, you play the role of banker and provide financing to the buyer. In addition to often collecting a competitive interest rate from the buyer, you only have to pay capital gains tax as you receive proceeds over time from the sale that are applied toward the principal or price the buyer agreed to pay for the property. Because of the complexity of this method, consider consulting with a tax attorney. Special tax credits for low-income housing and old buildings. If you invest in and upgrade low-income housing or certified historic buildings, you can gain special tax credits. The credits represent a direct reduction in your tax bill from expenditures to rehabilitate and improve such properties. These tax credits exist to encourage investors to invest in and fix up old or run-down buildings that likely would continue to deteriorate otherwise. The IRS has strict rules governing what types of properties qualify. See IRS Form 3468 to discover more about these credits. The 2017 Tax Cuts and Jobs Act bill created qualified opportunity zones to provide tax incentives to invest in low-income communities, which are defined by each state's governor and may comprise up to 25% of designated low-income communities in each state. States can also designate census tracts contiguous with low-income communities, so long as the median family income in those tracts doesn't exceed 125% of the qualifying contiguous low-income community. The new Qualified Opportunity Zone tax incentive allows real estate investors the following potential benefits. The capital gains tax due upon a sale of the property is deferred if the capital gain from the sale is reinvested within 180 days in a qualified opportunity fund. For investments in the qualified opportunity fund of at least 5 years, investors will receive